Welcome back to the deep dive. We are tackling a topic today that sits right at the intersection of high finance, personal anxiety, and, believe it or not, medieval law.
It's a strange mix, isn't it?
It really is. We are looking at the single largest financial transaction most people will ever make in their entire lives.
Without a doubt.
And yet it's one where the mechanics are usually, obscured by this mountain of paperwork and jargon that's almost impossible to get your head around.
It feels intentionally dense sometimes.
We're unpacking the mortgage, but we aren't just doing the Mortgages 101 walkthrough you might find online.
No, we're going a lot deeper. We've got a stack of research here, comparative studies, legal histories, economic analyses that all point to one thing.
Which is?
That the way most of our listeners, especially in the U.S., think about this debt is a complete anomaly on the global stage.
A total outlier.
It really is.
Yeah.
When you actually line up the data, the American mortgage market is. It's a unicorn.
Yeah.
It operates by a set of rules that just don't exist in most other places.
Okay, so before we get into that global tour and the big macro picture, we have to deal with the nature of the beast itself. Because, as the sources point out, this contract isn't just a loan.
Not at all. It's a very specific legal bind, an encumbrance that has evolved over hundreds of years.
And that history is hidden in plain sight, right there in the name. I was digging into the etymology provided in the notes, and it's surprisingly dark.
It is, isn't it?
It's not just some fancy French word for loan. It's law French from the Middle Ages. Mort, meaning
Yeah.
and gage, meaning pledge.
The death pledge. It sounds like something out of a horror movie or, a fantasy novel.
Exactly, a death pledge. When I first read that, my immediate reaction was, well, that feels aggressive. It sounds like you're literally signing your life away.
And in a way, you are signing away a huge chunk of your financial life. But the sources clarify the death part isn't necessarily a threat to the borrower's life.
Though the stress of a mortgage might feel like it sometimes.
I think we can all relate to that. But no, the death it's referring to is the state of the pledge itself. The idea is that the pledge, this security interest you've given the bank over your property, is dead or static.
Meaning it doesn't change.
Exactly. And it's designed to end. It essentially dies in one of two ways. There's the happy death, if you want to call it that.
I'm guessing that's when you pay it off.
That's it. The obligation is fulfilled. You make that final payment after 30 years. The debt dies, the pledge is terminated, and the property is finally released to you, free and clear.
And the unhappy death, obviously,
Is foreclosure. The pledge dies because the lender takes the property to satisfy the debt. The deal is over. It's concluded, but you've lost the asset.
So either way, the arrangement is designed to be terminal. It's not a revolving door like a credit card. It has a definitive end date where the gage, the pledge, must die.
That framing really changes the whole vibe of the closing table, doesn't it?
It absolutely does. You aren't just borrowing money, you are encumbering a piece of the earth. And that word encumbrance came up over and over again in the legal definitions. It's a limitation on your rights.
That's a great way to put it. You might hold the title, you might paint the walls and mow the lawn, but there is a heavy, invisible hand resting on that deed until the pledge is dead.
And that leads to this really common point of confusion, which the notes highlighted, about the players involved.
The mortgagor and the mortgagee.
Yes. In almost every other part of the English language, the or suffix implies the giver, and the e suffix implies the receiver. The employer gives the job, the employee receives it.
Sure, the actor and the one acted upon.
But in the mortgage world, people consistently get it backward. Intuitively, you think, I am the home buyer, I am receiving the money, so I must be the mortgagee.
And that's totally logical, but it's wrong.
Yeah.
Because it ignores the direction of the security of the pledge.
You have to follow the collateral.
Exactly. The pledge is coming from you, the homeowner. You are giving the security interest in your home to the bank. Therefore, you are the mortgagor.
And the bank is receiving that security pledge, so they are the mortgagee.
It seems like a small pedantic point, but it really matters because it defines the entire power dynamic. You are the one initiating the encumbrance on your own property.
Okay, so as the mortgagor, offering this death pledge, the very first hurdle is proving you're actually good for it.
Right?
This brings us to the mechanics of the loan itself, specifically underwriting I feel like most people view underwriting as just a bureaucratic box-checking exercise.
Sending in pay stubs, bank statements.
Yeah, a formality.
Okay.
But the source material highlights that this is actually a massive predictive modeling engine.
That's exactly what it is. It's the gatekeeping function.
Yeah.
The underwriter isn't just checking if your pay stub is real. They are trying to predict the future stability of your life for the next 3 decades.
30 years. It's an incredible thing to try and predict.
It is. And they do it by looking at key ratios. The two big ones are payment ratios and debt ratios. And while those sound really similar, they measure very different kinds of risk.
So the payment-to-income ratio, sometimes called the front-end ratio, that's the simple one. That's just the direct burden of the house itself, right? Your proposed mortgage payment versus your gross income.
Correct. It answers the question, can you afford this specific house on its own? But the one that really trips people up, the one that's the more holistic view, is the debt-to-income ratio, the DTI.
Or the back-end ratio.
Right. And the DTI is critical because it aggregates everything. It's the mortgage payment, PLUS, your student loans, your credit card minimums, your car lease, any other debt you have.
It's the total financial pressure you're under.
Exactly. And the research shows a really strong correlation between high DTI and default rates, which isn't surprising. But there's a psychological component mentioned in the notes that I found fascinating.
Oh,
A high DTI isn't just a financial metric. It's a proxy for psychological stress.
that makes perfect sense. I mean, if 45 or 50% of your gross income is already spoken for before you even buy groceries or pay for gas, you're living in a state of constant low-grade emergency.
There's no margin for error. A broken down car isn't an inconvenience. It's a catastrophe.
And that term house poor gets tossed around so lightly, but it's a genuinely precarious existence. You have the asset, this beautiful house, but you have no liquidity to maintain it or, to maintain yourself.
And lenders know this from decades of data. That's why those DTI caps exist.
Yeah.
They aren't just protecting their capital. They are statistically avoiding borrowers who are going to burn out under the financial and psychological load.
Okay, so that's the risk of the borrower. But there's another ratio that determines the safety of the asset itself, and that's the LTV loan to value.
This one seems straightforward on the surface. It's just the loan amount divided by property value.
So if I buy a $500,000 house and I put $100,000 down, that's 20%. My loan is $400,000. I have an 80% LTV. Simple.
It should be. But the value variable in that equation is where things get really slippery, especially in a hot competitive market.
This is the value equation problem from the research.
That's it. You have multiple conflicting definitions of value. First, you have the transaction value, which is simply what you agreed to pay the seller.
Okay, my $500,000 offer.
Then you have the appraised value. And this is the crucial one for the bank. In a bidding war, the transaction value can completely decouple from reality.
You mean I might agree to pay $500,000 because I fell in love with the kitchen and I beat out 10 other offers?
But the appraised value, which is the cold, hard, data-driven opinion of a licensed professional looking at comparable sales, might come in at $450,000.
And the bank only cares about the appraisal.
They only care about the appraisal. They don't lend on sentiment or bidding wars. They lend on collateral. And if the LTV, based on that lower appraised value, is suddenly too high, say 90% or more,
Then the whole deal can fall apart. Or I have to come up with an extra $50,000 in cash to bridge that appraisal gap.
exactly. And this is where the down payment, or a deposit, as it's called in UK law, functions as the ultimate risk buffer for the lender.
It's your skin in the game.
It's the ultimate skin in the game. If you have 20% equity from day one, you have a huge cushion. If property values dip 5 or 10%, you're still not underwater. You have a massive incentive to keep paying.
But if you have zero equity, you have absolutely zero barrier to walking away if prices dip even 1%.
And we'll definitely get to that when we talk about the crisis eras. But for now, let's assume you pass the underwriting gauntlet, you have the keys, now you enter the long 30-year phase of repayment.
And this is where the math, specifically the amortization curve, can feel incredibly demoralizing for a new homeowner.
It's a psychological shock for a lot of people. It's based on what's called the annuity concept.
A term from finance. What does that mean in plain English?
It just means the math is designed to produce a flat, predictable monthly payment for the entire life of the loan. Your principal and interest payment is the same in month 1 as it is in month 360.
Okay, that sounds good. Predictability is nice.
It is. But to achieve that flat payment, the internal composition of that payment has to shift dramatically over time.
And this is the classic shock of looking at your first ever mortgage statement. You write a check for, say, $2,000.
And you look at the breakdown, and you see that $1,850 of it went to interest, and $150 went to principal.
And you feel like you've made no progress. You're just running on a financial treadmill, paying the bank for the privilege of borrowing.
It absolutely feels that way, but it's just the reality of how interest works on a very large balance. In that first month, you owe the maximum amount of money you will ever owe. So the interest charge, which is a percentage of that huge balance, is at its absolute peak.
The bank gets paid first. They're getting the rent on their money.
They get their rent first. Whatever tiny sliver is left over chips away at the principal balance.
But the curve does accelerate, right? It's not a flat line.
Oh, it does, but it's slow.
Uh-huh.
Because you paid off that $150, next month, the interest is calculated on a slightly lower balance. So maybe the interest charge is $1,849, and your principal payment is $151.
So it's a flywheel that starts off incredibly heavy and hard to turn.
That's a perfect analogy.
Wow.
And it takes about 15 to 20 years on a 30-year loan for that flywheel to really pick up speed. By the last 5 to 10 years of the loan, the whole thing is flipped. Your payment is almost entirely principal, with just a few dollars going to interest. The math is engineered so the balance hits exactly zero on that specified end date.
Okay, so that's the standard repayment model that most people in the U.S. are familiar with. But the outline highlights some alternative structures that, frankly, sound terrifying. Specifically, the interest-only mortgage. This was a huge deal in the UK, right? And in the U.S. leading up to 2008,
It was massive in the UK, and it was the source of a major financial scandal. In an interest-only mortgage, your monthly payment covers only the rent on the money.
so the principal balance.
Stays completely flat, it never decreases. If you borrow $300,000, you will still owe $300,000 25 years later.
So you're just renting your own debt indefinitely.
Essentially, yes. The logic at the time, and this seems crazy now, was that you would take the money you saved by having a lower monthly payment and you'd put it into a separate investment vehicle.
Like what?
In the UK, it was typically an endowment policy, or later a PP or an ISA, which are just types of stock market investment accounts. The theory was that the stock market return on that investment would easily outpace the mortgage interest rate.
So you're trying to create an arbitrage. You're betting your house that the market beats the bank.
And you are taking all of the risk. And for millions of people, that bet went sour. This was the UK's endowment mortgage crisis. The investment vehicles dramatically underperformed the rosy projections they were sold with.
So borrowers reached the end of their 25-year term expecting this magic pot of money to be there to pay off the house.
And instead they found they were tens of thousands, sometimes hundreds of thousands of pounds short of the principal they owed.
And the loan is due. The term is up. The bank wants their £300,000 back. Now.
Immediately. It was a catastrophe. It forced people to sell their homes, take out new, expensive loans in retirement. It was a mess. And it forced a massive regulatory crackdown.
As it should have.
The Financial Services Authority in the UK tightened the rules so much that major lenders, like the Nationwide Building Society, effectively pulled out of the interest-only market for average borrowers. To get one today, you need a very concrete, verified, and frankly, bulletproof repayment vehicle. You can't just say, oh, I'll save up.
Okay, then there's the flip side of this, which is aimed at the other end of the demographic spectrum, the reverse mortgage. In the U.S., it's usually the HECM.
The home equity conversion mortgage.
Yes.
This turns the entire amortization curve completely upside down.
How so?
Instead of you paying down debt to build up your equity, you are consuming your equity to generate cash flow.
The bank pays you.
Right. You can get it as a lump sum or as monthly tenure payments for as long as you live in the home or as a line of credit. But here's the key. You don't pay any principal or interest monthly.
So where does the interest go?
It rolls up. It gets added to the loan balance. So every single month your debt gets larger and your ownership stake in your home gets smaller. It's called negative amortization.
It sounds like a solution for that classic problem of being house rich and cash poor in retirement.
That's exactly who it's for. Older borrowers who have a lot of equity but need cash to live on. But the compounding effect of that rolling up interest can be incredibly aggressive.
I can imagine. So what's a repayment trigger?
The loan becomes due and payable when the borrower dies or permanently moves out of the home, for instance, into a nursing facility. The danger is that if you live a long time or if interest rates are high, The rolling interest can consume the entire value of the estate.
So there's nothing left for the heirs.
Potentially, yes. In the U.S., the HECM is insured by the FHA, so the borrower, or their estate, will never owe more than the home is worth at the time of sale. But it can certainly wipe out the full value. It's a valid tool for some, but you have to understand you are essentially spending your house.
Speaking of interest rates, this brings us perfectly to Section 3, the menu of rates. This is where the whole risk transfer game really happens.
This is the core choice for most borrowers.
And in the U.S., the 30-year fixed-rate mortgage is the absolute gold standard. It's more than just a product. It's almost a cultural right.
It is, and it offers a level of predictability that is just. It's supreme. You lock in a cost of housing for 3 decades, inflation could hit 10%, rents in your city could double, the economy could go crazy.
But your principal and interest payment stays frozen in time. That is an incredible financial hedge for a household.
It's a massive form of insurance against volatility.
Yeah.
But that certainty isn't free.
No, you pay a premium for it, don't you?
You do. The initial interest rate on a fixed mortgage is almost always higher than the starting rate on a variable or adjustable rate product. You are paying the bank a little extra to take that 30-year interest rate risk off your hands.
Which brings us to the alternative, the adjustable rate mortgage, or the ARM. Here, you get a discount up front.
You get a teaser rate or a lower margin for the first few years because you, the borrower, are agreeing to take on the volatility risk.
You're taking the gamble.
You are. If the Federal Reserve hikes interest rates to fight inflation, your mortgage rate goes up. Your payment goes up. You are absorbing the shock so the bank doesn't have to.
So it's a fundamental trade-off. Do you want to sleep well at night knowing your payment will never change? Or do you want a lower bill today and are willing to risk it going up tomorrow?
That's the choice. The lower initial rate can be really tempting. It lets you qualify for a bigger loan. But as we saw in 2008, when those ARMs reset to a much higher rate, it can be devastating.
It's the ticking time bomb in your finances. But then the outline mentions something even more exotic. Foreign currency mortgages. This sounds like an ARM on steroids.
This is a phenomenon we rarely ever see in the US or the UK because our currencies are relatively stable. But it's very common in developing economies or places with a history of high inflation, like in Eastern Europe.
So what's the concept here?
The concept is borrowing in a stable, low-interest rate foreign currency, like the Swiss francs or the euro, because the rates are much lower than in your home country.
Okay, give me an example. Let's say I'm in Hungary or Poland, and my local mortgage rate in forints or zloty is, say, 12%.
But you look across the border and you see that you can borrow in Swiss francs at 3%.
I take the francs. It seems like a no-brainer.
Exactly. And for a while, it looks like you're an absolute genius. Your monthly payment is tiny compared to your neighbors who borrowed locally. But there's a huge hidden risk. You are earning your salary in Hungarian forints, but your debt is denominated in Swiss francs. You have just introduced currency risk into your personal housing situation.
So if the forint crashes against the francs, which happens a lot in economic crises,
Your debt load explodes.
uh-huh.
Your salary is the same, but you suddenly need twice as many forints to make your mortgage payment. You could owe double the amount of local currency overnight, even if you've been making all your payments on time.
My God, it could wipe you out.
And that is exactly what happened across Eastern Europe after 2008. It caused systemic defaults and a massive political crisis. It's the ultimate example of chasing a low rate without understanding the underlying structural risk you're taking on.
This segues perfectly into our global tour of mortgage markets. We've touched on pieces of it, but I want to really drill down into why the U.S. system is considered such an outlier. We take the 30-year fixed rate for granted, but the notes say this product basically shouldn't exist in a normal free market.
It really shouldn't. And to understand why, you have to think about it from a bank's perspective. Why on earth would you, as a bank, lend someone money for 30 years at a fixed rate of, say, 4%?
Okay.
Your own cost of funds, the interest you have to pay to your depositors for their savings accounts, that changes every single day. If the central bank raises rates and your cost of funds goes up to 6%, you are now actively losing 2% on that mortgage loan every single year for the next 2 or 3 decades.
It's a guaranteed loss. No rational bank would hold that risk on their balance sheet voluntarily.
They wouldn't. It's called interest rate risk, and it's huge. So how does the 30-year fixed exist in the U.S.?
Government intervention.
Massive government intervention. Enter the GSEs, the government-sponsored entities, Fannie Mae and Freddie Mac, and also Ginnie Mae for government-insured loans.
The alphabet soup of the American housing market.
That's them. And these quasi-governmental entities were created, starting after the Great Depression, to do one thing: grease the wheels of securitization.
Which means
They buy the mortgages from the local banks that originate them. They bundle thousands of these loans together, package them into mortgage-backed securities (MBS), and then they sell those securities to global investors, like pension funds and insurance companies.
and crucially, they guarantee the payments on those securities.
That is the magic ingredient. They add their government-backed guarantee. This takes the long-term interest rate risk completely off the local bank's books and creates a massive, liquid global market for this debt.
So, to put it simply, the reason I can get a 30-year fixed loan in Ohio is because the U.S. government has essentially created a backstop that makes that piece of paper valuable and safe for a pension fund in Tokyo or a sovereign wealth fund in Norway.
Precisely. Without Fannie and Freddie buying up those loans and guaranteeing them, the 30-year fixed mortgage would likely disappear almost overnight. Our market would start to look a lot more like the rest of the world.
Okay, so let's look at the rest of the world. Let's start with the United Kingdom. They don't have this massive securitization machine in the same way.
No, their system grew out of a completely different tradition. The UK mortgage market was historically dominated by building societies.
What are those?
They were mutual organizations owned by their members, not by shareholders, and they were funded by their members' retail savings deposits.
So they're taking in short-term savings.
And because they rely on short-term deposits, they can't possibly lend that money out for 30 years at a fixed rate. It would be financial suicide. So the UK market is, by necessity, dominated by variable rates, or what they call trackers, and short-term fixes.
Not a 30-year fix.
A 2-year fix, a 3-year fix, maybe 5 years if you're lucky.
Yeah.
After that initial period, the rate automatically reverts to a higher variable rate, and you're expected to remortgage.
That creates a totally different national psychology around housing and interest rates.
Completely. In the U.S., once you lock in your rate, you can basically stop caring what the Federal Reserve does for the next 30 years. It doesn't affect your biggest bill.
But in the UK, every time the Bank of England's Monetary Policy Committee meets, the whole country holds its breath.
Because millions of homeowners know their short-term fix is expiring in the next year or two. It makes the transmission mechanism of monetary policy much, much faster and more direct. If the Bank of England raises rates, millions of people feel it directly in their wallet within months. In the U.S., it really only affects new buyers or those with home equity lines.
Okay, now what about our neighbors to the north, Canada? I know they have a similar structure with these 5-year renewals, but the notes mention something really unique: the stress test.
The B20 guideline. This is a fascinating piece of macroprudential policy. It's a form of social engineering, really.
How does it work?
In Canada, even if you go to a bank and you negotiate a mortgage rate of, say, 4%, the bank is legally required to qualify you as if the rate were much higher.
So they're testing your ability to pay a phantom rate.
Yes. The rule is you have to qualify at the greater of a benchmark rate set by the Bank of Canada, or your actual contract rate plus 2%.
So in an example, I'd have to prove I could afford the payment at 6%, even though I'm only going to be paying 4%.
Exactly. The government is asking on your behalf, if rates go up by 2% when you renew in 5 years, will you go broke? If the answer is yes, you don't get the loan. Not even at the 4% you can afford today.
Wow. What was the impact of that?
It significantly reduced the maximum borrowing power for the average person. It cooled the housing market. But more importantly, it builds a permanent safety margin into the entire system. It prevents people from stretching to their absolute financial limit just to get into the market.
It's a paternalistic policy, but it seems to have worked in preventing a U.S.-style meltdown.
It has been very effective at promoting stability.
Now, let's cross the Atlantic to continental Europe. The outline says it's a diverse market, but mentions a common funding mechanism called a covered bond. How does this differ from the U.S. securitization model we talked about?
This is a really key structural difference. In the U.S., you have what's called an originate-to-distribute model. The bank makes the loan and immediately sells it, distributing to Fannie Mae. They wash their hands of the risk. In the European covered bond system, which is very popular in places like Germany with their Pfandbrief, the bank issues bonds that are backed by a pool of mortgages, much like an MBS. But, and this is the big difference, the mortgages stay on the bank's balance sheet.
Ah, so they still have skin in the game.
A 100% skin in the game. If those loans go bad, the bank eats the loss, not some distant investor who bought the bond. The bondholders have dual recourse to the bank itself and to the underlying mortgages.
That completely changes the incentives, doesn't it?
It changes everything. It naturally leads to much more conservative, careful underwriting because the lender has to live with the consequences of their lending decisions for years. And it's a big reason why default rates in Europe are generally much lower than in the U.S. It aligns the incentives of the lender with the long-term performance of the loan.
That structural difference seems to explain a lot about the relative stability of many European housing markets versus the boom and bust cycles we seem to specialize in. But the most radical difference of all is clearly Islamic finance.
This is a whole different universe.
We're talking about a system that prohibits the charging or payment of interest entirely.
That's right. Sharia law prohibits riba, which is broadly translated as usury or interest. The core philosophical basis is that money should only be a medium of exchange, not a commodity that generates profit by itself. You cannot make money from money. You can only make money from productive activity or trade.
So how on earth do you buy a house? You can't just pay cash. The whole point of a mortgage is to borrow money over time.
You do it by changing the fundamental relationship. The bank and the borrower are not creditor and debtor. They become partners or co-owners.
Okay.
There are a few models, but the notes highlight two main ones. The first, which is a bit simpler, is called buy bithman ajil. It's basically deferred payment sale.
Walk me through that. How does it work?
The bank buys the house you want from the seller for the current market price, say $300,000. Then, the bank immediately sells that same house to you, but for a marked up price, say $400,000, which you agree to pay in installments over 30 years.
So the bank's profit, which would have been the interest, is just built into the price tag of the asset they're selling you.
Exactly. It's structured as a trade, not a loan. But the more elegant model, and the one that's gaining popularity, is musharaka mutanakisa.
That's a mouthful.
It means a diminishing partnership.
Okay, break that down for me.
You and the bank buy the house together as partners. Let's say you put in a 10% down payment, so you own 10% of the house.
Definitely.
The bank puts in the other 90%, so they own 90%. You are co-owners.
Right.
Now, you live in the house, so you have to pay rent to your co-owner, the bank, for the use of their 90% share of the property.
Okay, that makes sense. It's fair.
But here's the clever part. Your monthly payment isn't just rent. It's structured as rent plus acquisition. A portion of your payment is rent, and the other portion buys a little more of the bank's equity share.
So next month, I might own 11% and the bank owns 89%.
Exactly. And because you now own more of the house, your rent payment for the next month goes down slightly because you're renting less of their share. So more of your fixed monthly payment can go towards acquiring even more equity.
That is surprisingly logical and elegant. You are slowly, systematically buying out your partner until you own 100% of the asset. The payments are tied to the use and ownership of a real thing, not to the abstract concept of interest on money.
It creates a direct link between the asset and the payment. But it did face significant legal hurdles when introduced in Western countries.
I can imagine how so.
Specifically, things like stamp duty or property transfer taxes. In the UK, for example, every time a property changes hands, you have to pay a tax. In this Islamic model, the property technically transfers from the original seller to the bank, and then from the bank over time to the borrower.
That's two transactions, so double taxation.
Precisely. It made Islamic mortgages prohibitively expensive and uncompetitive at first. But in a really interesting move, the UK government actually amended the Finance Act back in 2003 to recognize these alternative structures and waive the double stamp duty.
That's a huge deal.
It was a major move to adapt a Western legal framework to accommodate Islamic finance, and it opened the market up significantly.
That's a great example of legal systems adapting to reality. But what happens when the legal system has to deal with failure? We have to move on to Section 5, foreclosure, recourse, and insurance. This is where the rubber really meets the road.
This is the unhappy death of the pledge. Foreclosure, or repossession in the UK, is the legal mechanism for the lender to seize the collateral when you default. But the process can vary wildly.
You mean judicial versus non-judicial foreclosure?
Exactly. In some jurisdictions, the lender has to go through the court system to prove the default and get permission to sell the property. That's a judicial foreclosure. It can take months, even years, and gives the borrower many opportunities to fight it.
And non-judicial.
In other places, the mortgage documents contain what's called a power of sale clause. If you default, the lender can move to sell the property much more rapidly without a lengthy court process. It's much faster and cheaper for the lender.
But the big question, the one that really fundamentally separates the U.S. from almost the entire rest of the world, is the question of recourse.
This is maybe the most important concept in this whole deep dive. It defines what happens after the foreclosure sale if the house isn't enough to cover the debt.
Okay, so let's use an example. I owe $400,000 on my mortgage. The market crashes, I lose my job, I default. The bank forecloses and sells my house, but they only get $300,000 for it. There's a $100,000 shortfall.
That's called a deficiency. Now, what happens?
Yeah.
In a recourse jurisdiction, which is most of the world, Europe, Canada, the UK, and many U.S. states, you, the borrower, are still personally liable for that $100,000 deficiency.
The debt follows you even after you lose the house.
It follows you. The bank can get a deficiency judgment against you and then garnish your future wages, seize your other assets, freeze your bank accounts, and pursue you into bankruptcy. The debt is attached to you personally.
Okay, but then there are the non-recourse states in the U.S. This is the big anomaly.
This is the huge anomaly. In about 12 states, including big ones like California and Arizona, depending on the specific loan type, the loan is secured only by the property, period.
So in my example, if I'm in a non-recourse state, the bank gets the house.
And that's it. The debt is extinguished, they get the keys, and the story is over. They cannot sue you for that $100,000 deficiency. They have no recourse to your other assets or future income.
That completely changes the borrower's calculation, doesn't it? It creates what economists call a put option. If the value of my house drops below the amount I owe, I can just walk away.
And people did, in massive numbers. During the 2008 crisis, this led to the phenomenon of jingle mail, people literally mailing their house keys to the bank and just leaving. It turns the whole moral hazard equation on its head.
In Europe, walking away isn't a rational option because the debt will haunt you forever. In the U.S. non-recourse system, the borrower's risk is capped. Your maximum loss is the house itself and a bad credit score.
It absolutely encourages speculation and risk-taking.
Yeah.
If I can bet on house prices with the bank's money and my personal downside is strictly limited, I'm going to be much more willing to take that bet.
Okay, so to protect themselves against all these risk default, foreclosure, non-recourse laws, lenders use mortgage insurance.
They do, but we need to be crystal clear on this because it is probably the most misunderstood product in the entire industry.
Right. People hear the word insurance and they think it protects them. They think if I lose my job, the insurance will pay my mortgage for me.
It is absolutely not what it is. That product exists, but it's a separate thing called mortgage protection insurance. The insurance we're talking about, often called PMI or private mortgage insurance in the U.S., it protects the lender.
Let me repeat that. It protects the bank.
The bank is the beneficiary. You, the borrower, pay the premiums every month. But if you default, the insurance company writes a check to the bank, not to you.
That feels structurally unfair. I am being forced to pay for an insurance policy that pays out to my bank if I fail.
It is the price of high-leverage borrowing. The bank typically requires it if you have less than 20% equity, so an LTV over 80%. They are essentially saying, you are a high-risk borrower to us because you have so little skin in the game. We are only willing to make this loan if you pay for an insurance policy that indemnifies us against your potential default.
So it's a risk premium disguised as a separate product line.
That's a perfect way to describe it. If your house is foreclosed on and sold at a loss, creating that deficiency we talked about, the PMI company pays the bank the difference. The borrower, meanwhile, still loses the house, still has their credit ruined, and gets absolutely nothing from the policy they paid for.
All right, let's zoom out to the macro trends to start tying this all together. We've talked about how these different mechanisms work, but how do they impact overall economic stability? The outline mentions a UN study comparing the U.S. and German systems.
It's a really striking comparison of two philosophies. Germany has a system built on stability. It's funded by those covered bonds we discussed, which keep risk on the bank's balance sheet. They have a culture that values saving. And their nominal mortgage interest rates have historically hovered around a very stable 6%, with very low volatility.
And what's the effect on their housing market?
Historically, a very stable housing market. Until some recent global pressures, prices in Germany didn't double every 5 years, but they also didn't crash by 30%. It was a slow, steady, and frankly, boring market.
Contrast that with the United States.
The U.S. is a roller coaster. In the early 1980s, under Paul Volcker, mortgage rates hit 18%. 18. By the early 2000s, they had fallen to 3 or 4%. This incredible volatility combined with the originate-to-distribute model where banks don't hold the risk.
It's a recipe for crisis.
It has made the U.S. mortgage market the epicenter of multiple major global financial crises. The savings and loan crisis in the 1980s, and of course the subprime crisis in 2007 and 2008.
Both of which were, at their core, mortgage crises.
Absolutely. The subprime crisis was specifically driven by those toxic products we discussed earlier, the interest-only adjustable rate mortgages, given to borrowers with poor credit who couldn't possibly afford the payment when the rate reset higher. It was a catastrophic failure of the gatekeepers in underwriting.
And it was driven by the insatiable appetite of the securitization machine for more and more mortgages to package and sell, regardless of the quality.
Exactly. The incentives were all wrong.
So synthesizing all of this, the death pledge is so much more than just a monthly bill. It is this incredibly complex web of law, math, cultural norms, and government policy.
It really is. It's the bedrock of private property ownership for the middle class in the modern world. It's the mechanism that allows us to buy assets that vastly exceed our annual income. But the mechanics, as we've seen, matter enormously.
They really do. Whether you are entering a diminishing partnership with your bank in Kuala Lumpur, facing a government-mandated stress test in Toronto, or securing a 30-year fixed-rate bond in Chicago, the rules of that specific game will dictate a huge part of your financial destiny.
And I think realizing that you are the mortgagor, the one giving the pledge, is really empowering. It puts the agency back in your hands. You are the one initiating this. You are entering a serious long-term contract where the collateral is your family's home.
Understanding these rules isn't just academic, it's essential.
And I'll leave you with this one final provocative thought to chew on. We talked about the non-recourse system in some U.S. states, the ability to just walk away from the debt. And we talked about the Islamic partnership model,
Two completely different ends of the spectrum.
a deep philosophical divide. In one system, you are a partner with your financier, sharing in the risk and the asset. In the U.S. non-recourse model, you are a debtor who is actually incentivized to gamble on appreciation because the system allows you to bail on the crash while socializing the losses.
Which makes you wonder, does the specific legal structure of the American mortgage, this non-recourse anomaly, actually cause the very bubbles we were all so afraid of?
If you knew you couldn't just mail the keys back, if you knew that debt would follow you for the rest of your life, would you have been so willing to bid $50,000 over the asking price back in 2006? It's a question worth asking.
Next time you sign a legal document, maybe check the etymology. You never know what kind of pledge you're really making. Thanks for listening to The Deep Dive.
See you next time.